If someone handed you $100,000 right now and said, invest this in Australian property, what would you do? It's a question I get asked all the time, and the answer isn't as simple as you think. In this video, I'm going to walk you through how I deploy $100,000 in the current market. I'll cover the strategy, the numbers, the city, and the property type I target, and the exact logic behind my decision. This isn't financial advice, it's how I think through the problem. My name is Shawn, and I'm the head of research at PropSpotter, and we help those looking to buy investment property locate the best suburb and property for a quarter of the cost of your full service buyer's agents. Whether you've actually got $100,000 to invest or you're working towards it, this framework will help you think like a property investor in the right manner. Subscribe if you want more strategy content like this. First, let's establish the framework. $100,000 is a deposit, it's not the full purchase price. So the real question is, what can $100,000 in deposits and cost unlock? If I'm buying with a 20% deposit to avoid LMI, $100K minus costs gives me roughly $80,000 as a pure deposit, which means a purchase price around $400,000. That opens up limited options in capital cities. But if I use the investor equivalent of a lower deposit, let's say 10%, pay LMI, that same $100,000 could unlock a property of around $700,000 to $750,000 after costs. LMI costs maybe $10,000 to $15,000, but it dramatically increases my buying power and the quality of property I can access. Or option 3, I split the $100,000 across 2 properties using 10% deposits on 2 lower price properties between $350,000 to $400,000 each, diversification across 2 suburbs or even 2 cities. Each strategy has trade-offs. Let me walk you through the approach I take and why. Given the current market, here's my specific play. I take the $100,000 and buy a single property in the $500,000 to $600,000 or $650,000 range, putting down a 10 to 15% deposit, paying my LMI, and keeping a cash buffer for contingencies. Where I'd be looking at the growth corridors of Melbourne or Hobart in 2026. Specifically, I'd target a 3-bedroom house on a decent sized block in a suburb with a vacancy rate under 1.5% and a gross yield close to or above 4% with a view to get as high as I can. Bonus points for blocks that have well-placed houses and big backyards. Why a house and not an apartment? Houses give you land value, which is where the real capital growth comes from. They also give you future options. Granny flat potential, subdivision potential, renovation upside. Apartments have none of that. Why Melbourne or Hobart? Both have the strongest combination of growth forecasts, rental yields, and supply constraints. Perth is tempting, but the entry point has risen significantly. For $100,000 in deployed capital, Melbourne and Hobart offer the best risk-adjusted returns right now. Let me show you what this looks like on paper. A purchase price of $550,000, a deposit of 10% is $55,000, stamp duty in Victoria, which is the highest, will be $27,870. Conveyancing, inspections, other costs approximately $5,000, and therefore the total cash required is $87,800. That leaves me with a $12,000 buffer from my $100,000 deposit. Rental income, I'm being promiscuous here, but at a 5% gross yield. That's $27,500 a year, or roughly $528 a week. That is possible in Hobart. Annual costs, mortgage repayments on a $495,000 loan at 6.5% interest only are roughly $32,000. Property management at 8%, $2,200. Insurance, rates, maintenance, roughly $6,000. That makes my total cost approximately $40,200. So the property cost me about $12,700 a year out of pocket, or about $250 a week. That's the holding costs. Now, if the property grows by 6%, which is below the forecast for the outer ring Melbourne suburbs, that's $33,000 in equity in year 1. Your $12,700 holding costs just generated $33,000 in wealth. That's a return in invested cash of over 30%. And remember, rental income also grows. If rents increase 4 to 5% annually, within 3 to 4 years, the property starts approaching a cash flow neutral position. So ladies and gentlemen, that's how I'd invest $100,000. A single house in the growth corridor of Melbourne or Hobart, 10% deposit, accept the LMI cost. It's a cost of doing business, keeping a cash buffer for when shit goes wrong, and holding for the medium to long term. The numbers work because rental yields are strong, growth forecasts are positive, and the supply shortage underpins the whole thesis. Now, your situation might be different. You might have more or less risk tolerance. You might want cash flow over growth. That's fine. The framework still applies. Think about deposit strategy, location, fundamentals, and then run the actual numbers. I'll do this same exercise for $50,000, $200,000, and $500,000 in future videos. Subscribe so you don't miss those. Tell me in the comments, how would you invest $100,000? I'd love to compare notes. I'll see you in the next one.